You're listening to Kitchen Table Finance. Join Dave Shotwell and Nick Nauta as they cut through the complexity of financial planning and serve bites of investment advice that are both personal and practical.
Hey, Dave, how you doing today?
I'm doing great, Nick. How are you?
Fantastic. Excited to be closing out 2023, closing out podcast season 2 with a great episode, and looking forward to season 3 coming up here.
Yes, sir. Yes, sir. Closing out the year. We've done more podcasts than I can remember at this point. We've got tens of...
I think our number is actually, this might be 150. Don't hold me to it, but it's pretty darn close.
Episode 150.
Yeah, can you believe that? Would have thought we would have ran out of things to say about 75 episodes ago, but
there might be some people who say we did, but we're just not going to ask them.
That's one thing about financial planners. They can go on talking forever.
Goes with the territory.
So today's episode, Dave, is about setting realistic market expectations, especially in retirement.
Right.
What do we mean by realistic market? What is a realistic market expectation?
Well, there's a lot of research out there that shows that, particularly in bull markets, investors, the general investor, has an inflated expectation of what the market should do for them and how much money they should be making. And, there's the old cliche, right? We've all heard the formula for happiness is happiness equals reality minus expectations.
There you go.
So I don't think we're here today to debate the truth of that. I've heard that attributed to everyone from Socrates to Tom Magliazzoli from Car Talk on NPR. Okay. So don't ask me who came up with that formula or even if it's right. But I think when it comes to how we think about our investments and our portfolios, there does seem to be some truth to that, right? Disappointment
for sure
is the biggest hindrance to happiness when it comes to how your money does.
Yeah, absolutely.
So, when things are good, people think they should be better. And when things are bad, they expect those bad times are going to continue. And either way is a losing proposition.
Yeah, absolutely. Especially when you're thinking about, how do you set expectation, not only expectations, but also like, what are you going to base some of your projections on for retirement or, how does that all going to play out when you're talking about, hey, this is the money I'm going to live on. What should I base my return on for retirement? Right.
Right. So, as an example, Nataxis does these surveys of investor households periodically. And in 2021, they surveyed a whole bunch. I forget what the survey size was, but it was statistically relevant. Households with over $100,000 invested, and they found the average response to what people thought their next 12-month return would be was 17.5%. Okay.
Wow.
And that was in a year that had already been good. So it kind of emphasizes that idea that, things have been good. I expect they're going to be even better going forward. Now we know, 17.5% is not unheard of. We've had a pretty good year here as we wind down 2023 that actually did better than that. And we could talk about what we're going to be talking about what the expectations were for 2023 and what we think people are looking at 2024 here in a couple of weeks when we do our prediction.
Yes.
But, we know that day in, day out, long-term history for the S&P 500 is about 10%, right?
Yeah. And, a couple things, Dave, before we move on here, 17.5%, obviously a big number, but over 12 months, pretty reasonable. I remember when I first started back in the, I started in 2005, but there was a lot of people in the late 90s that assumed that over the next 10 years, they were going to be making somewhere around 20% a year over a 10-year time frame.
Exactly.
Which even causes bigger problems because it's not like a one-off 1 year. It's like, hey, this is what I expect to do over the next 10 years on average.
Right. But if you're going into a 12-month period expecting, especially when it's on the back of a year that's already been good, which is where the psychological factors come in. Mm-hmm. We know that like if returns have been below average, our expectation as portfolio managers would be that it's going to be above average then for a while, because it's going to revert to the mean. But people, these expectations, when I don't have exactly what the previous 12 months were when that study was done, but I know it was during a good market in 2021. That, if the market's been good, the odds are better, then it's going to be less than average, not necessarily negative, but less than average before that. Yeah. But people still have that outsized expectation. So, when markets are down, recency bias leads people to expect they're going to continue to be down. And, I don't have a study to back that one up, other than you and I know anecdotally, talking to clients over a couple decades now, that when the markets are bad, it's really hard to convince clients that the markets will ever be good again.
Right.
So, yet the average market correction only lasts about 2 months, and the 12-month return after a correction, kind of to your point, is about 13.7.
Yeah. So it's interesting, because we always talk, like, everybody knows the age old, like, you should, when you're investing, you want to buy low and sell high.
Right.
But the reason why people don't do it is because when things are bad, it feels like they're always going to be bad. Right. Like, it's a big mind trick in terms of perception and how you think things are going and will continue to go.
Market corrections are as regular as your birthday or Christmas. Yet every time we have one, it feels like the end of the world and things will never be the same again.
Right.
So,
well, the opposite of that is when things are going good, apparently people believe that that's going to continue.
And they're going to get better. Yeah. So, there is a whole school of thought behind momentum investing, and that's a topic for another day. But, our philosophy is, if things have been too good for too long, they're going to revert to the mean at some point.
Yeah.
So when you know that the long-term history of the S&P 500 is an average of 10% per year, which is pretty darn good, you probably shouldn't be betting in any given year that it's going to be higher than that, or have in your head that that's a realistic expectation. And then to take that a step further, most of the people that we work with are not 100% in the stock market.
Right.
Normally we're dealing with retirees who have a balanced portfolio, and, a 60-40 balanced portfolio averages right around 7.5% historically.
Yeah.
So,
and I think that's a number that people don't know that they probably should, right? Like, I think a lot of people know, like, the average, maybe this isn't true. Maybe people that I hang out with know, like, the long-term average of the S&P 500 is 10%, but I also know very few people that only are invested into just the S&P 500.
Right. I it serves as a good proxy, and the fact that the return has been pretty much spot on at 10% makes nice linear, packaged thinking. But you're absolutely right. So and so on either side of that 10% since 1980, we've seen a minus 39%. And a plus 38%.
Yeah.
So, that 17.5% expectation in 2021 is still well within that realm. But I think what we're trying to get at here is, year in and year out, don't get caught in that fear of missing out by whatever the headline of whatever the best asset is on that given day. Because I think that's part of it too, that sets people up for failure in this. They might be invested in a boring balanced portfolio that may be doing just fine with its 7.5% average, but they just heard about their buddy who, bought the right stock at the right time, bought Netflix at a slump or whatever, pick your name du jour. And that's what they, it's as much that is the anchor to expectations, when really the luck involved in picking that right stock at the right time.
Right.
Your buddy's telling you about the one he got right, but he's probably not telling you about the 6 he got wrong.
Oh yeah. Well, it's like fishing, right? Like
Right.
A, it's always a huge fish. It's not the hour spent on the lake.
Right.
But B, the
Right.
fish always gets bigger.
Right. Right.
Like,
Right. Right. The proper response to that is when someone asks you if you caught anything, you say nothing to brag about.
right, exactly.
That's the proper response. Nothing to brag about. And it really should be the same in the markets too. And then you leave them wondering, did he get the big one or did he not catch anything?
Right, exactly.
But so, to that idea, Longboard Asset Management did a study, a real interesting statistical analysis. They're a mutual fund, a hedged mutual fund strategy, and I won't go too much into that, but they looked at the entire stock market history, like going back to 1926. And in that time, the United States, the domestic stock market has created like $47 trillion in wealth. Wow. Meanwhile, the average stock in that stock market had a return of between 0 and minus 70%. Okay. Basically 4 to 5% of the stocks in the market. So figure roughly 20%. You've got a 1 in 5 chance of picking the right stock. Were responsible for 100% of the return, of the positive return.
Wow.
Yeah. So, and I find that interesting right now because everybody's focusing on the fact that basically 7 stocks have driven most of the market returns over the last year. That's not unusual. Right. That seems to be the norm more than the exception. So, if you want to beat that market index, you've got to pick the right 1 out of 5.
Yeah.
Before they become popular, before anybody else does. So what are your odds are not good just on that. And what makes the individual investor think that they have the skill to beat those odds? I know I don't. I've been studying the markets and building portfolios for 24 years. And I guess, that's maybe the one lesson I can definitely tell you is there's no rhyme or reason that gives you the ability to pick those stocks ahead of time.
Yeah, I think a great example of that too is because the hard part is after the fact, it's always like, oh, well, I should have known, right? But if you think of, I like to use the example of Amazon, right? Like Amazon was essentially like an online bookseller.
Right.
That's the point in time where you needed to invest in Amazon to experience all of the growth. Yeah. And if you invested money into the online bookseller that was Amazon, people would look at you like you were absolutely lost your mind about how phenomenal this online bookseller was going to be.
Well, meantime, at the same time, it was the expansion phase of Barnes and Noble of, the big bookstore, one spot, everything, go to the store, pick out your books, get all that, 2 stories of bookshelves, which have struggled ever since.
Yeah.
But it would have been a pretty big leap of faith at that time to see how that was going to play out.
I mean, just so much working against them, which is, in hindsight, it's easy. Everybody wants to get their books online, and also they're going to expand and start giving everything to your front door. But nobody knew back then. Even Bezos probably didn't really know exactly what that was going to turn into.
Yeah. Well, and it's funny how obvious these things seem in retrospect. Right. I think that Amazon makes a great example of that. Of course, it's a, multi-billion-dollar, behemoth at this point. But, but
nobody talks about the 10 other companies that were probably trying to do something similar that ended up not making it, right?
Right. I'd like to find a list someday of I'm sure it's out there, of all the computer companies that were just as viable as Apple and Microsoft in 1978, 1979,
Right. Well, we're kind of seeing it a little bit right now in the electric car market, right? The Wall Street Journal just put out an article that there's all these electric car startups and most of them are running out of money. and not doing very well.
Yeah.
None of them seem to be turning into the next Tesla is the point,
okay.
I believe.
Well, so, we've lived in the era of the big three automakers our entire lives, but look back 2 generations. Every guy in Detroit was starting a car company in his garage. It's the same, it's the same corollary. And who knows which one, can you pick the Ford or the couple guys that get together and create GM out of, the mess of mechanics that all were, building real cars?
Right. Well, and, could you imagine investing money into Ford? Because most people thought Henry Ford was off his rocker with what he was trying to do, right?
And he largely was. He was just crazy enough to get it right. I remember somebody telling me that the museum at Dearborn, the Ford
Henry Ford Museum,
the Henry Ford Museum. There's a whole wing of antique cars, right? And I remember somebody from Detroit describing it as Henry Ford's trophy room of all the companies that that he beat that didn't make it, and they all had weird names, Bob's car that he built in his garage with weird sides on it, and and it was. Anyway, we digress. There's also one of the guys I worked with a while ago had a picture of Microsoft's. It was like Microsoft's Christmas party picture or something like that, where they're all like these scruffy guys. There's like 12 guys in, football jerseys and scruffy clothes and long hair. And it said on the bottom, it was printed, "Would you have invested?" with a question mark. And I'll have to dig that up. That's out there somewhere. But yeah, if we set our expectations around those home runs, hit dingers, don't bunt, right? But really what you need to do is like Moneyball, get on base, right?
Yeah,
it doesn't matter.
Exactly.
Don't worry about the big home run. Worry about getting on base and staying on base consistently,
Yep. Exactly. Well, going back to our fishing example, right? If you catch a small fish every day, you're going to eat every day.
That's true.
If you're going after the whopper, you might have to wait 5 days before you eat.
Yeah, that's true. That's true. Got to make it last. So yeah, just, what investors need to keep in mind is the market swings like a pendulum in the short run. You're going to have outperformance, but that's going to lead to underperformance at some point. Those market averages are tied to the long-term growth in the economy, factors like population growth, productivity. These things don't gyrate like 25% in a year, right? The way the market might. But in the long run, those are the things that drive the markets forward and lead to those consistent long-term gains.
Mm-hmm. Well, I love this piece too. Like when you look at our financial planning assumptions, right? We're using 5.8% for a balanced portfolio. It's just based on where the market's at and kind of looking forward. But much easier in retirement to have a reasonable expectation and do better than that and maybe get a little bit more money than expecting a lot more and having to all of a sudden reduce your spending, right? Like nobody wants that to happen. Much better to be a little bit more conservative and outperform than it is to, think you're going to do better than you actually do and have to figure out what to do from there.
Yeah. 5.8% is kind of our baseline for a balanced portfolio in our software. So less than what the historical average would be. And, that is all about setting realistic expectations. I'd a lot rather have that conversation. Hey, you've got extra money you can spend. Than, gee, if we'd only made the 10% we'd plugged into your plan,
right.
That's not going to happen. So
Exactly. Happiness equals reality minus expectations. That's what I'm taking away from this.
That's right. Put it on a t-shirt.
I love it. You can add it to your tattoo collection that you want to get.
Right.
Well, this has been great, Dave. Very important information on how to think about things and how to set up your expectations and the importance of that and the importance of how you think about this stuff. So appreciate it as always, my friend.
Thank you, sir. Have a good day.
This is a Zedia Media production.